to speak about key developments in accounting and auditing aspects of CSR. Thank you, madam. Now I request the respected ex officio member to speak special address, give special address.
Yeah, thank you, Mona Sundram, sir. In fact, I take this opportunity to welcome the speaker from Bombay, where we had an interaction before a year during the Mumbai International Conference. And we came to know that she evinces a lot of interest in the CSR subject as presented papers at all India level. So nevertheless, I thought we'll invite her to Madurai first in virtual mode and then sometime in physical mode also. In fact, CSR is not new because in our country like ours, a lot of companies who have taught actually how CSR should be. We are learning from Tatas and other corporates. There have been a lot of CSR activities happening, but nevertheless, the government thought that let us make it a compulsory obligation to see that certain things are being achieved, or certain companies who are not doing, they kind of put into it. There's always a long debate that the money which I spent towards CSR activity can be claimed as deduction or not. The government says it can't be claimed as deduction because it is an effect which you give post profits after you have suffered tax. So there cannot be any tax benefit given for misuse, but the debate continues. And two updates I wanted to give on the institute front. First, the institute is successfully able to hold on to conduct the CA examination successfully, both intermediate and final, and only foundation is pending, which is going to start in next couple of days. So I take this opportunity to thank each and every member and student who have ensured to see that the smooth happening of the examination is being held, including the managing committee members of not Madurai branch, but across all the branches who also put in their efforts to see that it is happening successfully without any hindrance for the students during this tough time. And during the interaction, I was told that in the last 1 year, this is the only physical exam which has happened actually. No other institution has held its physical exams. So I think our institute definitely needs a round of applause for what it has done for the benefit of the students to see that their attempt is not wasted. Second, the difficult time. Yeah, second, the difficult time is what we are going through is the income tax website. Friends, the institute is seized of the matter, finance ministry is seized of the matter, but we all are not happy with the way things are moving. Probably let's hope things get better, because at the present stage, we are stuck with a lot of difficulties where the simplest thing we are not able to do, filing some appeals or, making some updations. There are a lot of menus itself which are not available. I will only request to write to our institute body who is constantly in touch with the finance minister's office to see that these are getting rectified. And also for your own safety, please go to the grievance menu and lodge a complaint. And I know that grievance will be closed in 1 day telling that it is resolved by giving some reason that we are under the process of doing things. Nevertheless, for your record tomorrow, for you to prove that you had attempted that and you did not get the response, please raise a grievance to see that there is no grievance. So with this, I think somebody will have to unmute Venkatesh.
Madam, please unmute all the person attending persons.
So again, we'll have to ask all to.
Yeah, Venkatesh sir, you have to unmute Venkatesh sir.
Venkatesh.
Either madam, as a host, you can unmute madam.
Yes, done, sir.
Yeah, sorry, I think I also got muted in between. So we are eager to await to hear from the speaker on CSR.
Thank you, sir. Thank you for your kind words. And thank you for your updation in the CA Institute workings. Now I request the Secretary, Madam, to introduce the speaker.
Good evening, members. It's my pleasure to introduce the young, dynamic speaker of the day, CA Charmi Shah, who is into practice since 2012, and her areas of practice related to tax matters, CSR, statutory, tax, and internal audits, company law, ROC, and other compliances. Her professional activities: she is a co-opted member of Women Member Empowerment Committee of ICI 2021-22, co-opted member of CSR Committee of ICI 2020-21, co-opted member of CCBMT Committee of ICI 2019-20, committee member of Students Committee and Study Circle Committee of the Chamber of Tax Consultants Mumbai 2018 to 2021. She is a member of Subgroup TDC Committee of ICI 2015-17. She has taken a lot of seminars on ICTS and income tax at different study circles of WIRC, Nashik branch of WIRC of ICI, Visakhapatnam branch of ICI, and a regular speaker at the Chamber of Tax Consultants. She is a regular faculty at CSR certificate course at ICI. And she has co-authored books published by ICI, the following books: Technical Guide on Accounting of CSR Funds by Third Parties, Handbook on Certification of Form CSR1, Handbook on Audit of CSR Activities, Technical Guide on Accounting for Expenditure on Corporate Social Responsibility, and her extracurricular activities. Apart from the above, she is also an avid sports person who has won lots of medals and trophies in sports like badminton, table tennis, target rifle shooting, and in yoga. She is a Mumbai district level winner in table tennis in 2015. She has also won lots of prizes in elocution and debate competitions at various places. With this big words, it's really great to see you so high in this age. We are happy to have you. Now it is your session. Please.
Thank you, madam, for the kind words. A very good evening to one and all. Thank you all the dignitaries on diet and Dungal sir for the special comments for me. Thank you, Madurai branch, for the opportunity. Hope all are in pink of their health and doing well for the important reset in this pandemic. So starting with our session, corporate social responsibility was first time introduced as statutory obligation for companies by the way of Companies Act 30 under section 135. Thereafter, the companies' rule were notified on 27th Feb 14 to lay down specification and procedure to be followed by the companies while discharging their CSR obligation. The Companies Amendment Act 1920 resulted in some major changes in CSR provisions under Section 135 of the Companies Act. To provide for notified changes, the Ministry of Corporate Affairs had released the draft Companies Rule in March 20, inviting public comments recently on.
Excuse me,
Madam,
Sharmi.
voice is break.
No,
You
there
have
are
to
two
unmute yourself in the other
connections.
login.
Yeah, there are two connections from the speaker's end.
Hello, now my voice is clear.
Yes, fine.
Hello.
Yes, sir. Yes, madam.
Okay. So I'll start with my presentation.
Yeah.
So now corporate social responsibility for the first time was introduced as a statutory obligation for companies by the way of Companies Act 13 by the section 135. So thereafter the companies rule were notified on 27th Feb 14 to lay down the specification and procedures to be followed by companies while discharging their CSR obligation. So the Companies Amendment 19 and 20 resulted in some major changes in CSR provisions under Section 135 of the Companies Act. To provide for the notified changes, the Ministry of Corporate Affairs had released draft companies rules, which are called draft rules, inviting for public comments. So recently, on 22nd January 2021, the MCA finally issued the company's amended rules, which are called the new rules, giving effect for CSR in Companies Amended Act of 19 and 20. But the provision shall not affect CSR projects or programs approved prior to 1st April 2021. So we do not require to see how legislation in India took place for Section 135 in the Companies Act, but just let's look at one starting from 2013. The enactment of the Companies Act 13 gave way to CSR in Companies Act, which is predominantly and the corporate governance issues. Now, it was very important step for CSR, which found way in the Companies Act. So India was the first country at that time to do so. Of course, Section 135 was part of it. But later on, there were many amendments that happened to it. But the key that happened was the Constitution of High Level Commission in 2015 for approved monitoring of implementation of CSR policies. And of course, that year there was inclusion of penalty clause, unspent balance of CSR fund to be carried forward, and unspent balance to be transferred to one of the fund in Schedule 7. Board's CSR committee was also made responsible for due diligence of the implementing agency. So coming on to 2018, another high-level commission was set up. So they included carry forward of unspent balance for the period of 3 to 5 years, imposing monetary penalty for non-compliance, mandatory impact assessment, strengthening the reporting of CSR, registration of impact assessment with the Ministry of Corporate Affairs, additional 5% of admin expenses for the company undertaking need and impact assessment, etc. So these things were recommended by the high-level commission. But in 2019, the Companies Amendment Act in 2019 included immediate preceding financial year for eligibility under Section 135, notified, not notified, transfer of unspent amount to funds mentioned in in Schedule 7, carry forward of unspent amount of ongoing projects, introduction of penalty clause for non-compliance, including imprisonment. So finally, in 2020, notification were there, which made changes in carry forward of excess spent and unspent amount relating to ongoing projects, transferring of unspent amount not for ongoing projects into Schedule 7 fund, and monetary penalties for non-compliance. So the amendment rule in 2021 came into force on the date of its official gazette, that was on 22nd January 2021. So unless explicitly provided elsewhere in this notification, it would be applicable from 22nd January 2021. So while some of the amendments will actually be relevant from 1st April 2021, some of them would have their immediate compliance implementation, that is from 22nd January. So today, firstly, let's look at the amended act. What are the changes that took place on 22nd January? Then we will take up the accounting, and then we'll take up the auditing aspects of CSR. So there are 3 new rules significant for these changes. First is the definition change. Second is shift from directional to mandatory CSR. The registration requirement for implementing partners with MCA, increased rigor for internal control, and focus on impact creation. So each of the point will take in detail in the next subsequent slides. CSR is now a statutory obligation, and before that it was not there. So as a result of new rules, corporate social responsibility is now defined under Section 2D to refer to the activities which is undertaken by the company in pursuance of its CSR obligation under Companies Act. So the amended rule further identifies the activities which do not qualify towards CSR requirements of the company. And which are these activities which are excluded from the list of CSR activities are The first one is activities undertaken in pursuance of the normal course of business of the company. So the question arises whether the employees can be migrated to their home during this COVID-19, and that amount which is spent by the company can be granted as CSR for the company. So many circulars and notification has come out which clarified that migration of other workers can be claimed as CSR, means other workers of the other company. But migration of their own employees will not be considered as CSR activities. So normal course may include sale, supply of goods and services, so not part of CSR. The mere absence of profit motive will not take an activity out of a normal course of business. So, however, in view of COVID pandemic, an exception to this was created by the MCA, which was given notification on date 24th August 2020, allowing companies to engage in research and development activity of new vaccine, drugs, medical devices in normal course of business. To undertake such research and development in relation to COVID-19 as a CSR obligation. But this exception was only for the 3 financial year, that is from starting from 2020 to 23. So only 3 financial year, that is 2021, 21-22 and 22-23 were given exception to. And this exception has been duly incorporated in this new rules subject to certain conditions. Which are these conditions? The first condition is that such research and development activities shall be carried out in collaboration with any of the institutes or organization mentioned in Schedule 7, item number 9. To the including public funded universities, IITs, Indian Council of Medical Research. And the second exception was the details of such activities shall be disclosed separately in the annual report on CSR, which should be included in the board's report. Going on to the next activity, an activity undertaken by the companies outside India shall not be considered as CSR except for training of Indian sports personnel representing any state or union territory at national level or India at international level. So first, before the amendment, it was activities outside India not included. Now little change and a certain exception is included. The third point is contribution of any amount directly or indirectly to any political party under section 182 of the Act by the company shall not qualify as CSR. There is no changes at this point before and after the amendment. And the fourth is activities benefiting employees of the company as defined in section 2K of the Code of Wages 19 Act. So 2 key points that are changing here in this point is activity benefiting employees of the company is employees under Code of Wages Act. Before the amendment, Code of Wages Act was not in purview. This is very significant change. The meaning connotations of the word employee that is now connected with Code of Wages Act. So for our understanding, the employees or people which are hired for reward are only taken. So moreover, the regulation itself gives definition for contractual employees. Also, that extent, the definition should not include contractual employees. So coming on to the second point of employees benefit part, initially it talked about benefiting employees and community. It was okay. But the draft rule came in March 2020, also indicated significant benefit that talked about 25% of the benefit. So now the amendment which have come in it too is too specific and taken away the word significant. So that extent, any benefit that goes to employees or any projects which goes to employees which actually gets disallowed. And the second point is word family. So the initial draft of 2020 spoke about the family and its benefit. But the current situation, the word family is taken away with. So the interpretation can be, if it is not benefiting employees but benefiting family, still it can be said to be CSR activity by the company. And big benefits to employees to be avoided. So the question arises, does it mean that the employees cannot be the beneficiary of the CSR projects? So if done at society at large, of course, it can be a CSR activity. For this, let's take an example. A company made hospital beds for a society at large. So, but in those beds, there is no special reservation for employees of the company. But in case they use it normally as others in the society, that does not mean that that amount spent on the employees will be reduced from the CSR spend. So the employees as an organ of society can use those beds and they cannot be excluded, or certain that expenses cannot be excluded from CSR expenditure. The fifth point is activities supported by companies on sponsorship basis for deriving marketing benefit for its product or services. So here there were FAQs released by MCM. So let's take an example of favor marketing or sponsorship. So if sponsorship has done for product but not deriving benefits for own product or services by that sponsorship. So one of my clients' organization had taken up an initiative of sponsorship of a part of some urban city considering environment, sustainability, hygiene perspective. So this is unlinked to their product. So such kind one can explain to their CSR committee of the company that we are not getting any benefit from such sponsorship. So it can be considered as CSR activity. But let's take an example of sponsorship which cannot be considered as CSR activity. For example, if a bank motivates a customer to spend 5 lakh rupees on credit card, and the bank says to the customer that if you spend 5 lakh rupees on credit card, then we will contribute 500 rupees towards any charitable activity. So if that spend 5 lakh rupees by the customer or the 500 rupees spent by the company considered as CSR activity, the answer will be no. Because the direct sponsorship is making and benefiting the company. So many a times organization sponsor ball pens and materials. So here we have a direct or an indirect nexus, etc. But if you can have sensitive analysis to conclude here that there is no nexus to the benefit earned by the company, then only CSR activity can be considered. Else you will have a tough time to prove to the CSR committee of the company that it is a CSR spend. So look at the projects or facts. Then finally the board or the committee of the company see what to do. But finally, this is a very gray area. The importance and the language in the agreement of the MOU will decide finally whether the expense made is CSR spend or not. So for example, a COVID-related activities awareness is specifically permitted as CSR activity as per Circular 12 January 2021. So there can be too much marketing advantages from this too. But by the circular, this CSR activity is allowed. So the company, let's take another example. That a company has built a water cooler everywhere, and on it has carved its logo of the company, which gives its marketing, which is used for its marketing purposes. So there is a brand visibility by the CSR activity also. So just as it markets its company, the company doesn't deprive it or the expense made on water cooler, it doesn't get deprived of it being considered as CSR activity. The putting on logo is not non-beneficial to the company. It is also considered as CSR activity. And the last is activity carried out for fulfillment of any stat obligation under any law in force in India. Now, there are certain definitions which are introduced in this amended act. They are ongoing projects, administration overhead, and eligibility entities. So moving on in detail, that why did they change this definition and what are the changes they brought in, which made a full change in the outlook of CSR. So first, going on to the ongoing projects. So finally, CSR policy rule 14 defined a multi-year project undertaken by the company in fulfillment of its CSR obligation, the maximum allowed duration of which was 4 years. So 3 years excluding the year of commencement. So the definition also includes projects that were initially not approved as multi-year but are later extended beyond 1 year by the board on reasonable justification. So ongoing projects entail certain added responsibility for the companies, such as requirement to monitor their implementation as per approved guidelines. So by including this definition, an attempt is made to clear the ambiguity which were being seen in the previous projects. So now the implementation of which goes beyond the stipulated period of 4 years can also be considered as ongoing projects. So as per current rules, the company may not be able to undertake such projects as a CSR activity because they shall not qualify as an ongoing project. And any unspent amount in that regard shall automatically be transferred to funds specified under Schedule 7 as per Section 135 of the Companies Act. So taking some example, if the company contributes to an annual running expense of a cancer hospital, the spending of the next...
Anand.
Please go
let's
ahead.
take the example again. Yeah. So if company contributes to the annual running expense of a cancer hospital, the spending for the next year cannot be regarded as an ongoing project, because every year they are spending on their cancer hospital expenses. So that cannot be considered as ongoing projects. The second example is installation of a new facility at the same hospital. In the same hospital, they are giving also the annual running expense of a cancer hospital, as well as now in this year, they are installing a new facility. So if already undertaken during the year, it shall be considered as an ongoing project. So if this installation of the facility is halfly done in this year and the half is pending for the next year, it can be regarded as ongoing project. So to regard it as an ongoing project, is it necessary that some spending must have been spent during the year and certain is left for the next year? This all depends on the binding commitment on the part of company during the financial year. So the fact that nothing has been spent during the year should not preclude it from ongoing status. So all the things will depend on the MOU that is signed between the company with the implementing partners, or with the company itself if it by itself it is doing its CSR activity. So the expense of the retention money is rolling the expense to the next year and then claim it for the expense of that year. Going on to the next definition, that is administration overhead, is the latest amendment introduced the administration overhead as a new term, which refers to expenses incurred by the company for general management and administration in relation to its CSR functions. Before, there was ambiguity on the part of administration overhead, and this amendment rule has very well defined the overhead as a definition. So this definition explicitly excludes expenses directly incurred for designing, implementation, monitoring, and evaluation of a particular CSR project from the ambit of administration overhead. So the board is required to ensure that the administration overhead incurred in furtherance of CSR do not exceed 5% of the company's total expenditure. So the meaning of administration overhead was, however, not specified under draft rules, but assigning a definition in terms of new rules is a welcome step as it gives a greater clarity to the companies. So in my opinion, the government should also mention a few examples of the costs that will qualify as administration overhead for better understanding of the term scope and ambit. But under amended Rule 7, the board has been given the responsibility to ensure that the administration overheads in relation to CSR do not exceed 5% of the CSR expenditure of the company. And the companies carrying out impact assessment have been allowed to claim another 5% of the total CSR expenditure of 50 lakh rupees, whichever is less as a CSR expenditure. Going on to the last definition, that is eligible entities. This is done by the company because the third, and it is defined as the third parties. So what are the eligible entities as per this CSR amended rules? Are the first, the company established under Section 8 of the Act, or registered public trust, or registered society, or registered under 12A and 80G of the Income Tax Act. It is also including an entity established under Act of Parliament or state legislation. And it is also including a company established under Section 8 of the Act, or registered trust or registered society established by central government or state government. Now, and the last one, which entity is eligible, is the company established under Section 8 of the Act, or a registered public trust or a registered society registered under 12A and 80G of the Income Tax Act. And the most important part is having an established track record of at least 3 years in undertaking such similar activities. So the title of the Rule 4 has been changed from CSR activities under CSR Policy 14 to CSR implementation as a result of 2021 amendment. So the Ministry of Corporate Affairs, with Companies Amendment Rule 2021, shifted CSR spending mandatory from the voluntary spending. So in one of the articles said that India has equated CSR with spending part, whereas in other countries it is equated with the responsibility part. So in India, spending is considered to be the main crux in the CSR and in the responsibility as well. So what are the implementation of in case of unspent CSR funds? So in case there is a CSR liability and the entire amount is spent, then it has to be reported in the director's report. But if the entire amount is not spent, then we have to consider whether there is an ongoing project or is it not ongoing project. So if it is an ongoing project, then within 30 days, the amount which is not spent has to be deposited in the unspent CSR bank account. The bank account should be specifically named as unspent CSR, and it should be separate from all other accounts in the name of the company. Now, if there is ongoing project and it is not ongoing project, and if there is an unspent amount, then it has to be got transferred to government funds notified in Schedule 7 within 6 months or 30 days. So within 6 months, that is September 21, if the project is not ongoing, it has to transfer that amount, unspent amount, to the government fund notified in Schedule 7. So recent amendment which has changed the compliance for CSR to be spent of 2% of the average net profit from the last preceding 3 financial year. So up to March 2020, we should spend 2% of the average net profit of the last preceding 3 financial years. So if not spending by the company, then till now we just had to give a report or give reasons in the director's report. But the Companies Amendment Act as on 22nd Jan 2021. Now, if you not spend, then you have to give it to one of the specified funds. So rule is that an unspent amount of not ongoing projects, then you have to deposit in one of the specified funds in Schedule 7 within 6 months. That is September 21. So earlier, there was not mandatory to make provisions for the same. But now, it would be mandatory to make provisions for the amount which is not spent at the end of the year. So either you spend it, or if you don't spend it, make a provision in the books of accounts. So it is not that you can spend it at a later. You have to transfer it into the specified fund within 6 months. So if it is for ongoing projects, then it should not more than 3 years, and then you have to transfer to a separate bank account within 30 days after the financial year, called as CSR unspent account. So transfer the amount in bank account and then use it for 3 years. But at the end of 3 years, if it is still not spent, then you have to transfer it into a specified fund or Schedule 7. So now question arises for fund which does not spend up to March 2020. So there are 2 ways that the company can dealt with, where it can where it was unspent, they disclose it, but no provision was made and give reasons in the director's report. So, but the other way was they made provisions in the book as unspent CSR account. So now if this amount not used by March 2021, this has to get transferred to Schedule 7. And it can be said that this amount does not belong to this year. So it should be deposited in the bank depending on ongoing and not ongoing. So the board shall still explain the reason for not spending. This remains. For example, if the project is not finished as it is ongoing, so I park my money in the project, then identify the amount required to be done in the project for not indefinite period, for maximum 3 years. So for that, you have to identify the outlay required for the ongoing projects. That is one part. And the second part is the amount not retained has to be transferred to National Unspent Fund within 6 months from the end of the financial year. This national fund is not yet constituted by the government. So if it is not constituted, then the amount will go to any of the fund which is specified by the Schedule 7. So we do not have actually total 6 months to decide whether we are retaining the amount or not. Why I said not 6 months is we have to get board's approval for retaining the unspent amount. So for approval, we need actually list down the reasons and analysis of the amount to be retained. So most board reports are within 45 days. Board meetings are from 45 days from the end of the financial year. So therefore, effectively, the complete analysis will take 2 months from the end of financial year. So effectively, in my view, you only have 1.5 months from the end of financial year to decide whether the project is ongoing or not ongoing, or what amount is to be kept as retention, or you want to transfer it into the Schedule 7. So we have 6 months to transfer the amount, but we do have only 2 months to analyze and retain the amount practically. So action plans need to be made, and CSR committee still has to include in one of the agendas in the board meeting. It's a huge task which has to be completed in 1.5. So ongoing projects defined as multi-year projects not exceeding 3 years excluded the financial year in which it was commenced. So board may extend duration of the project to make it an ongoing project. So board cannot approve for more than 1 plus 3 years. The overall period would be max 4 years. So the company may think there is less visibility, but it's not the case. We have to create provision for 4 years ongoing project amount which is unspent to be dropped in scheduled bank in separate account, which can do for capital expenditure also. Moving on to the next point is the board to monitor implementation of ongoing projects and shall be competent to make modifications. So the board has to monitor and not the committee is competent to do the job. The main reason is for review, revise and pay attention to each and every project by the board by themselves. The next point is on board's approval, excess CSR spend allowed to be carried forward to succeeding 3 financial years. So set off of excess amount was not allowed till the amendment, but now it is allowed. So if we take an example, so the example says that if a company has to spend 10 crore rupees and in the year has actually spent 15 crores, excess 5 crores can be carried forward and set off for the next preceding years. So in the next year, you can spend less amount also because you are carry forwarding the excess amount spent. So set off of excess amount you can use for next 3 years. But they have specified 2 conditions to be fulfilled for taking the excess to be carried forward. What are the conditions are? They have to pass a board resolution and the surplus arising from any CSR project should not be considered in the amount which is carried forward. So under the new rules, a company is further allowed to spend CSR amount for creation or acquisition of a capital asset, which is held by the company established in the section 8 of the company, registered public trust or a registered society having charitable object and CSR registration number. Beneficiary of the said CSR projects in the form of self-help group, collectives, entities, and a public authority. So as argued in the report of high-level committee on CSR, the rationale behind allowing companies to use CSR amount for capital creation or acquisition is to encourage sustainable and effective initiatives. So the idea is not limit CSR amount to revenue expenses and instead use it to create capital assets that would yield future economic benefits. So the genesis comes from high-level committee report from government felt that overall intent of legislation is to work for public good. But there are companies who were saying that they are doing CSR, but they were creating assets in their own books, which means you are creating an asset for enduring benefits which could be appreciated. So till now, what was happening that, for example, you are running a school program as a part of your CSR activity for acquiring land and building. So NGO is running school, but the building is sitting in the books of the company and getting appreciated. They also, this high-level commission saw that in case where a mobile health care van was running for public good, was appreciating in the books of the company and not the NGO which is running the mobile health care van. So the report, the high level commission report said that implemented rules also. And practically, it means that starting from 22nd January 21, where rules have got notified and implemented, all the companies which have kept the asset in their own books have to transfer that asset, out of which in the books of their NGOs or the implementing partners which are in their possession. So they also have said that existing capital asset is to be transferred within 180 plus 90 days. So any capital asset created by the company prior to the commencement of this amended rule 2021 shall within a period of 180 days from the commencement comply with the requirement of the rule, which may extend further not more than 90 days with the approval of the board based on reasonable justification. So you have to identify all the assets which are lying in the company's book and transfer that asset within 180 plus 90 days. And going forward, it would be also important for the board and committee to really look forward that if any asset is created, then ownership needs to be with each of the bodies in, and the company should be the custodian of the same. So as per section 135(1), every company having net worth more than 500 crores, turnover more than or equal to 1,000 crores, or net profit more than 5 crores during any financial year, shall constitute a corporate social responsibility committee of the board, consisting of 3 or more directors, out of which at least one director shall be an independent director. There was certain relaxation given in this amendment rule that says that where the amount to be spent by the company does not exceed 50 lakh rupees, the requirement for such constitution of the CSR committee shall not be applicable, and the functions of such committee provided under this 135(9) may discharged by the board of directors of such companies. But if the committee is formulated, then the board has to be given the power to alter the annual action plan in accordance with the CSR committee's recommendation based on reasonable justification. So when compared to an original provisions of CSR committee under CSR rules 14, the new rules appear quite detailed. The earlier rule vaguely mentioned instituting transparent monitoring mechanism for CSR implementation without specifying its requirements. So the new rules make process easier by laying down what all needs to be necessarily included by the company in its action plan. So pursuant to this new rule, the CSR committee has given a task for formulating and recommending to the board an annual action plan in pursuance of its CSR policy, which includes list of CSR projects to be undertaken by Schedule 7, manner of execution, modalities and utilization of funds and implementation schedules, monitoring and reporting mechanism for the projects, and details of need and impact assessment. There is a major change by this implementing partners. So mandatory registration with central government. It was in the draft rule also to make this as a regulatory concern. But as of now, they only require to do registration. Maybe in future, it can be in regulatory in nature. So registration should be with the income tax authority as well as Ministry of Corporate Affairs. The second point is form CSR 1 to be filled electronically and submitted to the registrar by the implementing partners. So rule 42B mandates that the form CSR 1 shall be signed, submitted electronically by entities on MCA portal and shall be verified digitally by a chartered accountant in practice or company secretary in practice. So on submission of form CSR1 on the portal, a unique CSR registration number shall be generated by the system automatically. And this CSR registration number of implementing partner is to be disclosed in Annexure 2. So not required for implementing partners of the project approved prior to 1st April 2021. If it is an ongoing project, this is not required, but if it is a not ongoing projects, registration is compulsory. Implementing partners has to be have the registration under 12A and 80G of IT Act. So therefore, it seems only ongoing projects may be carried out by the unregistered implementing agency. So there are some consensus that CSR expenditure will not be qualified for tax purposes. Then why are we bringing section 12A and 80G mandatory to register for register of companies? For this, two reasons were there. First, because 12A and 80G registration organization is better monitored by the authorities and they have all the filings. So from next year, all old charity organization who is registered under 12A and 80G will require to get themselves re-registered. So now they will have a better control. And the second possible reason is from last certain year, lot of non-profit organization who came forward and said that we want to become the implementing partner. So government wanted them to plunge in this business. So that would be a possible reason why this requirement of re-registration has come. So the implementing partners should have a mandatory registration with the central government having 12A and 80G, and the entity has to file CSR1 electronic with the registrar, and this provision is applicable from 1st April 2021. So going on to the next is increased rigor on internal control. So it might be a kind of new terminology for people working in CSR domain space. But you know, some of the things that said bring this kind of foray is the board has to satisfy that CSR fund is used for the purpose and manner approved. The CFO or person responsible for financial management has to certify CSR fund utilized for the manner and purpose approved by the board. So all these things were very clearly point out a kind of high rigor in the terms of compliance. And you know, this kind of recommendation and CFO certifying definitely will require a high maturity in terms of internal control. So what would be your input for a company designing a robust internal control? To look into a design perspective, one thing that stands out is the CFO certifying companies. So what we generally see, and it's varied towards companies. So a lot of CSR initiatives are carried out by their HR admin of the companies. So a lot of rigor will go into it. So a CFO is certifying someone from the team of CSR, and the internal audit team also has to ensure that there will be a proper internal control in this. So CFO certifying, it will see from internal financial perspective, that is guidelines, what amount gets qualified for spending, make a checker kind, which in which schedules item in the schedule 7 the expenses are made. So robust process should be ensured for what kind of sampling, impact study. You have to check on financial checks also, and now there will be a qualitative check by the CFO himself. So the board has to monitor implementation of ongoing projects with respect to approved timelines and year-wise allocation. Then the new disclosure templates are applicable from financial year 2021. So what are the details required to be disclosed? First, excess CSR spend carry forward and set off, surplus arising of CSR projects, unspent CSR amount transferred to unspent CSR account and or Schedule 7 funds. So separate disclosure for ongoing projects and other than ongoing projects, details of capital asset created or acquired under CSR, the disclosure on website will be the composition of CSR committee, policy, and projects which are approved for ongoing basis. Impact assessment for impact assessment, two things is to be kept in mind. That is aggregate spending, and second spending is particular project. So the company can't just spend the amount. They have to see there is a social impact of the project on the society. So the impact assessment is mandatory, and impact assessment expenditure limits is 5% of the mandated CSR or 5 million, whichever is less. And for that, three things are to be checked for application of an impact assessment. First is company with average CSR obligation of INR 10 crores or more in immediate 3 preceding financial year shall take impact assessment through independent agency. Second is impact assessment to be taken for CSR projects with outlay of 1 crores or more. And the third is impact assessment to be taken for projects completed not less than 1 year before undertaking the impact study. So the impact assessment report has to be placed before the board, and details and reports of impact assessment undertaken and amount spent on the same is to be disclosed in the annual report of CSR. So that does not mean that impact assessment for other projects may not be done. So if you have to claim expenses for impact assessment to be done and claim as CSR expenditure, it has to trigger all the 3 points. So thus, after the notification of the new rule, the company qualifying the mentioned threshold shall be mandatorily required to carry out impact assessment of their CSR contribution. So it is hoped that such a requirement will result in more meaningful contribution by the company towards the society. And there is, however, scope for clarity with respect to provision allowing companies to claim 5% towards CSR expenditure for impact assessment. So prima facie, it gives an undertaking that such companies have the option to claim 10% in the total as their CSR expenditure, 5% for administration overhead and 5% for impact assessment. So although the same has not been explicitly mentioned in clear terms anywhere in the amendment, and a statement from the government in this behalf can remove the ambiguity. But earlier it was ambiguity, but the definition has nearby cleared little more of the doubts. So NGO you have taken for implementing the direct project expenses or project overhead. So 2021 amendment introduces a new term, international organization, which is defined under section 2G of an organization notified by the central government under UN Act 1947. So the High Level Commission on Corporate Social Responsibility headed by Injeti Srinivas in 2018 had recommended the introduction of international organization in India's CSR regime. So the recommendation has been duly incorporated, pursuant to which the companies are allowed to take help of international organization in designing, monitoring, and evaluating their CSR projects, and also in assisting and getting assistance from the international organization for their capacity building of their personnel. So it is noted that the draft rules also proposed engagement of international organization with respect to implementation of CSR projects subject to prior government approval, but the same has not yet been notified in the new rules. Penalty clause in case of a company fails to disclose unspent amount in annual report of CSR or and transfer unspent amount into a fund specified in Schedule 7 within specified time, or and transfer unspent amount relating to ongoing projects into unspent CSR account within specified time, or an transfer amount remaining utilized in unspent CSR account after 3 years into fund specified under Schedule 7. In case of not ongoing projects, the company in default has to pay a penalty lower of 1 crore or twice the amount required to be transferred by the company to the fund specified in Schedule 7 or CSR account. So in case any officer in charge is found to be in default, then every officer of the company in default shall be liable to pay a penalty of lower of the amount of 1/10 of the amount required to be transferred by the company. Going to the accounting part of CSR, there are two kinds of accounting: social accounting and financial accounting. So what should be the accounting in books of accounts? And we are here to see how accounting is to be done for CSR expenditure, specifically for Section 135 of the Companies Act. So the amount of contribution made towards CSR would generally be treated as an expense and charged to profit and loss account unless it gives rise to an asset. So according to the guidance note of CSR, an asset would be recognized on the basis of an evaluation of control over the asset and accrual of future economic benefit of the company. So accounting would be as per Section 135(5) of the board of every eligible company shall ensure that the company spends in every financial year at least 2% of the average net profit of the company made during the 3 preceding financial year in pursuance of the CSR policy. And if in the case the company has not accomplished 3 years, it would consider any such year from its incorporation. So Section 135(5) provides that the company shall give preference to the local area and area around it where it operates. So for spending the amount earmarked for CSR activities, this is clarified in our General Circular of 6/2018 dated 28 May 2018. So accounting would be in the 4 arena. First would be CSR contribution received for various projects. Second would be as per return on unspent amount, accumulation of unspent amount, and expenditure out of accumulated unspent amount. So first, the CSR contribution received for various projects. So if the third party or the company itself is receiving contribution from different companies for different projects, then the amount should be identified in the books of account project wise, and the receipt as well as the amount spent corresponding to the projects shall be marked and reflected separately. So both the contribution received and expenditure made should be charged to income and expenditure account of the third party, and fixed asset, if any, acquired should be taken to the balance sheet of the third party. Now, what would be the accounting entry for return of unspent amount? So what is basically return of unspent amount? The CSR donation which is received by the third party must be applied for charitable purposes within a specified period as per within the specified period as per the project program in CSR policy of the donor. So in case of the CSR donation are not utilized within the specified period during the year, the same may be either returned to the donor or the same should be utilized as specified by the donor company. So what could be the accounting entry in case of return of unspent amount? It would be CSR contribution A or project A debit to bank account. The third point is accumulation of unspent amount. In case the amount required to be spent on project remains unspent at the end of year, then the entity needs to accumulate the balance amount to be utilized in future period. So such unspent amount at the end of the year would be carried forward to the next year, and the required formality or any compliance if the third party is registered in the Income Tax Act should be done. So if the entity is registered under Section 12A, then the charity entity needs to e-file Form 10, specifying the purpose of accumulation before filing of return of income. And the accounting entry for this accumulation of unspent account would be CSR project A or B, whatever we specify, to CSR fund project account. And the CSR project fund account should be taken to the balance sheet. Coming on to the next, expenditure out of accumulated unspent amount. So what is that? It's when the required compliances are made under Income Tax Act, the accumulation for 5 years is treated as application of income in the year of accumulation under IT Act. So in subsequent years, when the expenditure is made out of such accumulated fund, the accounting entry would be CSR fund for project A, B, whatever, account debit to bank account. So the amount spent out of this accumulated fund would not be charged to income and expenditure account, but would be reduced from the fund which is created in the balance sheet. After the accounting, let's consider where this CSR expenditure is recognized and measured. So in any of the case, whether the CSR fund is expended by the company itself, or it's spent by the third party, or it is contributed from the fund, or it is done through registered entities, in all the cases, the company has to charge to its expense to the statement of profit and loss account. And the unspent amount would be treated as per Section 135 and 135(6) of the amended Act. And this Act for 135 is for not ongoing and 36 is for not ongoing projects. We have to transfer it to within 30 days from the end of the financial year, or have to transfer the fund in the specified Schedule 7. Now, what will be the recognition and measurement criteria for CSR spend in case there is any surplus earned from CSR projects? So, any surplus arising from CSR activity shall not be part of a business profit. So, such surplus shall be used for the following within a period of 6 months from the end of the expiry of the financial year. But after the Amendment Act, it is said that this surplus has to be plunged back into the same project. If any surplus is earned, the same amount would be added to the fund which is created for the same project. Then it has to be transferred to unspent CSR account and spent in pursuance with the action plan of the CSR policy which is made by the CSR committee. The next is CSR expenditure wrongfully claimed. What would be the recognition criteria in case CSR expenditure is wrongfully claimed as product, service, cost, or not shown separately as CSR? It has to be recognized as a non-cost item as per declared CSR policy of the company, and it has to be reflected in the profit reconciliation statement. What would be the recognition criteria by eligible expenditure will be whether a particular expenditure spent on CSR will be allowed under Income Tax Act for the company will depend on its nature itself. So in case it is of revenue expenditure, then CSR, if the company has incurred expenditure on the activities specified in Schedule 7 of the Companies Act, and CSR expenditure is relating to business of the entity, then such expenditure should be treated as an expense in the statement of P&L. But where the company receives a grant from others for carrying out on CSR activities, the CSR expenditure should be measured net of the grant. And the last one is income earned during the course of conduct of CSR activity. So any surplus or income arising from CSR activities not arising from a transaction with its own owners of the company, then it would be considered as income for the accounting purpose. Next, we go to auditing part. When the government has brought in an amendment in the Companies Act providing for a 3-year jail term for violating CSR norms, the government was, however, reconsidering its decision and may make it a civil offense. So the inclusion of details of CSR spending in the financial statement and enhancement of disclosure is likely to make a CSR framework transparent, robust. So there is a huge spending of CSR. So audit work is very important role for the economy. The requirement of audit of CSR activity seems not to be mandatory as per Companies Act 30. So however, various provisions of the Companies Rule 14 requires monitoring and reporting mechanism for CSR activity. So which are the provisions which had changed are Rule 4, 5, 6 of CSR Rules 14. So what the rules specify is that provision to sub Rule 2 of 4 says that the company of a board of a company should decide to undertake its CSR activity through a company established under Section 8 of the Act or registered trust or a registered society, and such company or trust or society shall have an established record of 3 years in undertaking the similar programs of projects for utilization of funds, for modalities and monitoring reporting mechanism. The Rule 5 said that the CSR committee shall institute a transparent, robust and monitoring mechanism for implementation of CSR projects or programs. And Rule 6, that is sub-rule 1B of the Rule 6 said that CSR policy of the company shall inter alia include monitoring process of such projects or programs. Hence, the monitoring of CSR activities and its reporting is being mandatory by the company's rule. So also it is the responsibility of the companies to monitor the funds of the company which are to be utilized by CSR policy of the company. So in case where the company is complying with the CSR obligation by just mere donation or contribution, which is specified under Schedule 7 of the Act, there would not be any requirement of obtaining any report for such contribution made. So, however, where CSR obligation is done through third party as per rules, report of utilization certificate should be obtained by the third party auditor by the company's CSR committee to give an effective CSR compliance of monitoring, reporting, and requirement of CSR policy rules. Going on to the responsibility of auditors, there are two cases where the auditors comes in view, where the company undertakes the CSR activity by itself, where a company undertakes CSR activity through third party, which is eligible section 8 company registered trust, registered society, etc. So where a company undertakes CSR activity by itself, the auditor of the company should take care of certain things while auditing the program. What are those things? Are first, the activity and report undertaken should be with the Schedule 7 activities. And in case only mere donation or contribution is done by the company, it should also be as per Schedule 7 of the Act. And separate disclosure of the expenditure of CSR activity is to be made in the Schedule 3 of the Act, which is now amended right now. And the auditor should also take care that the expenditure of on the project is incurred as per new rules 2014. Also, the auditor should take care that the company has complied with applicable accounting standards in accounting, recognition, measurement, disclosure relating to CSR spend. So he has to also comply with certain auditing standards, like for example, SA 250, which is for consideration of law and regulation in an audit of financial statement, and SA 720, which is for auditors' responsibility relating to other information. So the auditor has to comply with the guidance note of audit of expenses also. So wherever a company undertakes CSR activity through third party or eligible 8 registered company, it should obtain an independent practitioner report on utilization of such CSR fund from the auditors or CA in practice of the third party, to whom the funds are given by the company for implementing the activities, CSR activities. So auditor should check whether in its management review, the perfect CSR website is given, a perfect link is given where the CSR is being planted. So now going on to the next, where the auditor or CA in practice of the third party is before the issuance of independent practitioner report on utilization of CSR fund. So in the case, the third party has spent the fund on CSR activity as per section 135 of the Companies Act, which is read with Schedule 7 of the Act. Verification of the CSR spend has to be done as per guidance note on audit of expenses, which are issued by the Institute of Chartered Accountants of India. So now companies should obtain CA auditor's report on utilization of CSR fund. So every funding agency includes CSR corporates as per utilization certificate to track their project expenses, which may be audited or unaudited. So generally, unaudited utilization certificate is sent to funding agency with the signature of the head of the organization. An audited utilization certificate is asked only once or at the end of the project. So what the problem was faced by the utilization certificate was that there was no uniform format defined by FCRA or the income tax. So generally, either a chartered accountant would give utilization certificate as per his format, or sometimes funding agency provides specific format for it. Because of this non-uniform format, problems are faced by statutory auditors of corporates. So he has to certify all the expenditures spent by the companies under section 135. So he needs to comply all such expenditure by the company from the CSR fund given to various small NGOs organizations. So, but the utilization received from small NGOs were very in different format. And since all the formats of utilization certificate was so different, it was very difficult for the auditors to compile the utilization certificate at the head office. So to solve this problem, the institute has given a specific format to CSR fund. The specific format is called the Independent Practitioner Report on Utilization of Fund. The format of this report is being issued after duly vetting the accounting and assurance standard of standard board, and wherever a company is required to comply with CSR regulation of section 135, it may undertake CSR activity either by the company or through the third party. So the Institute of Chartered Accountants of India has said that the companies had obtained CA's auditor's report on the utilization of CSR funds. So if CSR activities is done through third party in an advisory issued of members of ICI, and the companies to whom CSR provisions and the Companies Act 13 said that whenever the company undertakes the CSR activity through third party or NGO, it is advised that all the companies should obtain independent practitioner report on utilization of such CSR fund from auditors or CA in practice of the third party NGO to whom the funds are being given by the company for implementing CSR activity. So this the format of report is same as corporate audit report, which includes narrative and annexures for expenses. The first part is the introduction part and the second part is the management responsibility part. So here if the management is NGO, that means that NGO has certain responsibility like maintenance of internal control and applying appropriate basis for ensuring the estimates to be given in the project. Since we know that now UDIN is being compulsory by the Institute of Chartered Accountants for all chartered accountants in practice or issuing any certificate, so UDIN is mandatory for grant utilization certificate, and which includes a certificate for fund and grant utilization for charitable trust institutions, for NGOs, for a statutory authority, and under FEMA, FCRA, and other laws. The government is providing various relief measures and relaxation in order to boost businesses and the economy. So in the same context, the MCA has postponed the applicability of CARO 2020 from financial year 1920 to financial year 2021. So now the MCA wide order of 17th December 2020 has changed the applicability date of the CARO 2020 to financial years commencing on or after 1st April 2021. So CARO 2020 would be applicable for financial year 21-22, and CARO 16 will still continue to be applicable for financial year 2021. So the CARO is the listing of reporting requirement that will be needed by the auditor who audits companies or businesses. So MCA has issued CARO 2020 to enhance the scope of audit, and the MCA in consultation with NAFRA released CARO 2020. So it lists out the subject matter on which the applicable companies are mandatory required to report. So there is a list of amendment in CARO 2020. There is no alteration in applicability of CARO. And this comprises of overall 21 clauses against 16 clauses in 2016. So 7 new clauses have been entered, 1 clause is being merged, and 1 is deleted. So let's look into the amendment that are made in CARO 2021. That is clause 20, reporting on CSR compliance. So the fund, what are the newly entered provision is the fund transferred by the company and other than those designated to ongoing CSR projects must be specified in the report. We have already seen what is section 135.5 and 135.6. It is transferred to unspent account in the bank within 30 days and transfer to Schedule 7, a fund specified under Schedule 7. So in a nutshell, new clause has been inserted in CARO 2020, which requires the auditor to report on whether unspent CSR amount is to transfer to first a fund specified under Schedule 7, where no specific project has been carried out or assigned, or a special designated bank account that is within 30 days of the end of the financial year. Now, moving on to the last point, that is, what are the duties of the auditor for disclosures to CARO? Now, auditor needs to evaluate the applicability of Section 135 to the company. So, the auditor needs to obtain first the board's approval for CSR policy as recommended by the CSR committee. Second, it is agenda and minutes of the meeting of the CSR committee. And the third, most importantly, is the working of the amount required to be spent under Section 135 of the Act, detailing the calculation of average net profit, which is calculated in accordance with the provision of Section 198 of the Act in consultation with Section 135. And evaluate whether if the total amount required to be spent by the company has been appropriately determined at 2% of the average net profit or not. So the auditor is also required to obtain confirmation from the management and review that whether CSR activities is undertaken by the companies as per the all the funds or activities which is accordance with Schedule 7 of the Act. The auditor also has to verify that the amount spent in respect to ongoing projects are with supporting documents such as expenditure receipts, bank statements, etc. So, in respect of, in case of unspent amount for any of the year, the auditor shall verify the bank account to ensure whether it is earmarked for CSR activity, open for respective financial year only, and it is specifically named as unspent corporate social responsibility account. So, though the auditor is not required to report, that the auditor is required to verify that the amount transferred to specified bank account has been utilized for CSR activity as per CSR policy within 3 years from the date of such transfer, failing to which it has to transfer to Schedule 7 of the Act. The auditor has also to check whether the company has a record of provision in their balance sheet to the extent in compliance with provision of AS 29 and Index 37, which says provision contingent liability, contingent asset in respect of unspent amount on ongoing projects. So the auditor should also evaluate if the company has considered disclosure of such unspent amount as commitment in contingent liability with requirement of Schedule 3 of the Act. So in addition to the procedures till now what the auditor has followed, the auditor should also consider the provisions of the company's Rule 14, which reports of unspent amount under the clause. Unspent amount which we have already seen transfer to 30 days or Schedule 7. So next is the auditor may also refer to the guidance given in guidance note for accounting for expenditure on CSR activities issued by ICI until the amendment was made for Section 135 of the Companies 13. So the auditor may also consider obtaining a representation from the management regarding compliance of requirement of Section 135. So in case the company has In case the company has not transferred any unspent amount in case of any ongoing projects to a special account, which is specified in 135(6) of the Companies Act, within the time limit, that is 30 days, the auditor should ascertain certain things and which should be specified in the CSR CARO report. Which are those details? Relevant financial year, amount identified for spending on CSR activities for ongoing projects, unspent amount, amount transferred to special account, due date of transfer to the account, actual date of transfer of account, and number of days of delay. They want each and every minute details for date and delay date. So now as an auditor, we have to disclose in our CARO report, and if there are delays shown in the report, it would give a bad effect on the brand of the company. So the company would be liable to transfer the account in the specified account in the date specified by the rule. So this disclosures in CARO have made the company more vigilant about their disclosures and by doing CSR activity timely. So the auditor should also have, in respect of ongoing projects, the company has transferred any unspent amount to an special account within 30 days from the end of the financial year in compliance with section 135(6). Then this compliance has to be shown in the report. The auditor should also report the non-compliance, if any, in respect of any earlier financial year also. So here they have written financial year, so we can write the current financial year as well as we can write the preceding financial year. The details like amount unspent on CSR for ongoing projects, amount transferred to special account within 30 days, and amount transferred after due date. And also they want the date of transfer. So in the auditors should appropriately in situation where the time period is specified for 135(6) has not yet elapsed at the time of issuance of auditor's report, the auditor should report under the clause on the basis of the information till the date of auditor's report. So in such circumstances, the auditor should appropriately bring out this fact while reporting under this clause. And what should the comment be like? The comment be like the company has not yet transferred the amount remaining unspent in respect of ongoing projects to a special account till the date of our report. However, the time period for such transfer, that is 30 days from the end of the financial year as permitted under subsection 6 of the section 135 of the Act, has not yet elapsed till our report. So by specifying this comment in your auditor's report regarding CSR, you become safe. And it will, if there is non-compliance on the part of the company, as an auditor, you become on their safe part. So this sentence could be included, and so I have listed down in my presentation also. Also in this year 2021, there was an amendment to the Companies Act 13 in Schedule 3, which made changes in the disclosure which were earlier not required in case of corporate social responsibility. Now for CSR, what are the disclosures required as per Schedule 3 are listed down in the slide. Where the company covered under section 135 of the Companies Act, the following schedule disclosed. First is amount required to be spent by the company during the year. Second, amount incurred. Amount required to be spent by the company during the year will come as 2% of the average net profit of preceding 3 financial year as per section calculation of section 190. The second, amount of expenditure incurred would be the real expenditure which are made by the company. Shortfall at the end of the year would come as A minus B. If you have expended less, then you will get the shortfall. Total of the years preceding year's shortfall can be calculated from preceding year's report. There also needs a reason for shortfall. So why did the company or the committee or the board fail to spend their CSR? What are the nature of CSR activities? Nature of CSR activities wanted to be disclosed in Schedule 3 for the reason that they are as per Schedule 7. So they just want it on the face of the report that the company has not done any non-compliance with regards to the company's rules or Section 135. Also, they want the requirement of details of related party transaction or contribution to the trust controlled by the company in relation to CSR expenditure as per relevant accounting standards. Related party transaction is very important to be disclosed. They are also to be disclosed in notes to accounts of the annual report and also in the director's report. If any implementing agency is also related party of the company, then also it has to be specified in the board report, notes to accounts, as well as in Schedule 3. And the last is where a provision is made with respect to a liability incurred by entering into a contractual obligation, the movement in the provision during the year should be shown subsequently. So these are the requirements which are to be disclosed in Schedule 3 of the Companies Act. Also, there are certain reporting requirement in CSR which are to be done in financial statements, in cash flow statement, board of directors report, also in notes to accounts. So the disclosure makes the CSR activities, its reporting, its estimate, and its expenditure very important for each and every company and to make their company a brand in the eyes of the stakeholders. So with this, I complete my presentation. If there are any questions, you can also ask.
Thank you, madam, for your valuable inputs to us with the lucid explanation regarding CSR activities, both in accounting as well as auditing aspects in practical manner. Thank you, madam, once again. It is very useful to our members, madam. Now the floor is open for discussion. Any questions? Please raise your questions, unmute yourselves.
Looks like no questions.
Oh, okay. Now I request the secretary, madam, to give vote of thanks.
Good evening, members. On behalf of Madurai branch of SARC of ICI, I thank our speaker, CA Sharmi Shah of Mumbai, for accepting our invitation to address our members on key developments in accounting and auditing aspects of CSR. Your presentation was very good, madam, and the coverage on the topic was exhaustive, which shows your in-depth knowledge on the topic. On behalf of managing committee members, I thank our respected ex officio member, CADC Jain sir, for introducing the speaker to Madurai branch. I also thank our chairman, CA Mohanasundram sir, for arranging the session. I thank all the members for your participation. Our next CPE is on 24th July by CA Bhanushekar sir from Chennai, on the topic being representation and appeals, including faceless appeal. Requesting all members to participate in all forthcoming events organized by our branch. Once again, I thank you, CA Sharmi Shah, for your wonderful session. Thank you all.
Mani Meghala, madam, you can invite members to come for the AGM also.
Yes. Dear members, we have our AGM on 24th July, Saturday morning, 11 o'clock, and already the notice and the reports have been sent by mail. Again, we'll be sending a reminder tomorrow. So please participate in the AGM also. Thank you. Thank you,
Virtual
members.
AGM, more important this time.
Thank you. Thank you all. Thank you. We come to the
Thank
end.
you. Thank you.
Thank you,
Thank you,
Sharmisha.
madam.
It was a wonderful presentation.
Thank you, ma'am.
So thank you all of you. Take care.
Thank you. The meeting is now concluded. Thank you.